Good morning, everyone, and thank you for joining me. This morning, I want to cover the usual performance that we cover in our monthly sessions. But in addition to that, I do want to talk a little bit about market volatility, and I will present to you some very interesting data that hopefully will give you some comfort that although over the short term we may see some market volatility, over the long term, that short-term volatility is something that we should worry a little bit less about. But before I get into it, I just want to remind you of what our mission and vision is. And when I say we, I speak on behalf of the Sygnia Umbrella Retirement Fund. So as a mission, we want to restore confidence in the retirement fund industry through the creation of innovative products that can make it easier for the members of this umbrella fund to plan for a comfortable retirement. And our vision is through these innovative products and through the savings and the investments that we can create for you is to enable members ultimately to be able to retire comfortably. So as I mentioned, I do want to spend some time talking about market volatility and long-term investing. I mean, as a reminder, why are we all here? We are all here to assist the members in getting that comfortable retirement. So as a reminder, how does one retire comfortably? Well, there's a number of items that you need to tick in order to be able to retire comfortably a number of years away from today. So the rule of thumb is that a member should be working for 35 to 40 years. So that means that when a member starts working in their early 20s, they should be saving for their entire working life right up until their early or mid 60s when they choose to retire. So that should be that 35 to 40 years. So every single month while you are employed from your very, very young days, you should be saving a portion of your salary towards retirement. So what is that portion that you should be saving? Well, there's been many, many clever actuaries through the years that have done studies, and the rule of thumb is about 15% of your monthly salary. Of course, the more you save, the better off you will be at retirement, but the rule of thumb is if you can save 15% of your salary for those 40 years, and achieve an investment return of inflation plus 5%. And you'll see that's the point that I've highlighted on the slide because this is the point that we'll talk about today. Then what else do you need to do? So you'll be working for about 40 years and saving every month during those 40 years. You'll be saving about 15%. We'll take care of the investment returns on our side, and I'll show you how we do that. But then members also need to make sure that if they're changing jobs through this 35 or 40-year working life, that they actually preserve their retirement benefits. So meaning that if you work for company X and you've saved for, let's say, 2 or 3 years and you move to company Y, instead of taking out your benefit and spending it and starting again from zero, you should actually be taking that pot of money along with you to all your different employers as and when you change jobs. You should be using all of your retirement savings to buy a pension. So the rules are that if you are in a provident fund, you could essentially take the full amount in cash, but it's advisable that you actually use as much of that benefit at retirement to purchase a pension. In a pension fund, you are restricted to taking 1/3 in cash, and with the other 2/3 you have to buy a pension. But of course, the more of this money that you use to buy a pension, the higher your monthly benefit will be at retirement. For a lot of members, they either start saving too late or they haven't been saving at the 15%. In order to make up for that, what you could do is also make additional voluntary contributions into the fund. And if you are one of the members that has either been contributing a lower percentage or you've happened to have taken out a withdrawal benefit, it is best to speak to a financial planner. In fact, it's best for every member out there to speak to a financial planner to make sure that their individual circumstances have been taken into account and to make sure that they are on track to receive a comfortable retirement when they do retire. So as I mentioned, I've included one of those bullet points in bold because this is the part that we want to speak about today, how market volatility affects that investment return, how we actually construct portfolios to beat inflation over the long term. So how do we achieve an inflation +5 return over the long term, assisting our members to retire comfortably? Well, most of the members follow a life stage model, which means that they will be invested in an aggressive portfolio for most of their contributing life. And these portfolios have been designed to beat inflation over the longer term. If members are invested in one of our life stage models, then we take care of their needs according to their age, and we do that automatically. So how we do that is we know everybody's birthday, we know, we have everybody's details in terms of dates of birth, ID numbers, and we are able to transition members as they start getting closer to retirement from more aggressive to more conservative portfolios. So just a reminder of what the default investment strategy is of the Sygnia Umbrella Retirement Fund. It is a life stage model. So when I speak about the life stage model, I know that the bulk of the members are defaulting into these life stage models. But members are able to also opt out of these life stage models, and they can create their own investment strategies. But the bulk of the members do follow this investment strategy. So I am speaking for the majority when I speak about being invested in the life stage models. So how the life stage model works, this again, just as a reminder, is we will automatically transition members from a more aggressive to a more conservative portfolio the closer they get to retirement. So you'll start off in your very young days being invested in a 70 portfolio, meaning that about 70% of this portfolio will be invested in growth assets. Growth assets being your local equities, your offshore equities. Then from 6 years to retirement, we start transitioning you to a more conservative portfolio, and you'll have less allocation to these growth assets. So every year, as you get closer to that retirement age, you will have less and less of the aggressive portfolios and more of the conservative portfolios. But the key to that comfortable retirement and those bullet points we spoke about a few slides ago is to be invested in a more aggressive type of portfolio for the majority of your working life. And then just a reminder again, management committees together with their consultants, they make a decision on one of the 3 life stage models. So it would either be the skeleton range, the signature range, or the synergy range. But they all have the same inflation, type of targets over the long term, broadly speaking. So they're all targeting at least inflation +5 over the longer term. So just to take a step back from an investment theory perspective, why do we call some of these portfolios more aggressive than others? Well, an aggressive portfolio from an investment perspective is considered a portfolio that takes on quite a bit of risk, but that risk is rewarded theoretically over the long term with a higher return. So if you look at this diagram, you'll see risk is on the horizontal axis, and the further right you go, the higher the risk of the portfolio. And what risk is, to put it in simple terms, if we want to take it back to basics, it really is the risk of capital loss. So what is the risk that you invest in a share and that that company fails, or potentially that company is overvalued, so you purchase a share for 100 Rand, but the true value of the company is only 50 Rand. Well, there is risk of capital loss. So there is a risk that you put money in a company that's actually worth less than what you bought it for, and in that sense, you will actually lose some of the value of your portfolio. So from a theory perspective, as I mentioned, the higher the risk, the higher the return. And typically, the safest portfolios are the ones on the left side of the risk spectrum. So you'll see these money market portfolios, but they're also providing you with the lowest return. So if you're investing in cash, any money market type of instruments, it's very unlikely that you will put money in the bank. You'll put 100 Rand into the bank, and if you go back 2 or 3 years later, it's very unlikely that that money wouldn't be there. So the risk of capital loss is very small. But then if you do want to take a little bit more risk, you'll see the investment grade corporate bonds. They also provide a slightly higher return. Then your stocks, so your large companies, companies such as Naspers, companies such as BHP Billiton, it's unlikely that they're going anywhere. It's unlikely that you wake up one morning and Naspers is no longer there without any warning signs. So investing in these type of stocks, yes, it's risky, because at the end of the day, it is a share of a company that you're purchasing. So there is risk of either a small capital loss or maybe a big capital loss. But theoretically, because these companies are well established, they're listed on the stock exchange, they've got many boxes that they need to tick before they can be listed on that stock exchange, they are safer than companies that have just started up. And that's why mid-cap equities, so mid-caps are companies that are smaller from a market capitalization perspective. They are high on the risk spectrum, but they also would provide you theoretically a higher return over the longer term. And then the riskiest in this basic investment example is your small cap equity. So these are small companies. These are companies that are potentially still in very much their growth phase, which is why if you had to invest in one of them and this company was successful, it would provide a much higher return than a very well-established company that has less growth in it. So on the risk and return spectrum, the more risk you take over the longer term, members will be rewarded for that risk. So the way we've constructed our portfolios, if you again look on a risk and return spectrum, you'll see that there is a money market portfolio for members that might have a very short-term investment view. So maybe you know that you're going to withdraw from the fund and you want to do something specific with that money. You could put it in the money market portfolio, but your return over the longer term is also very low. So you're taking on hardly any risk, but you also wouldn't have much return. Then we have your low risk portfolios, and these are all our 40 portfolios. So you'll see there we've got the Signature 40, Skeleton 40, and Synergy 40. So these 40 portfolios have about a 40% allocation to equities, and the remainder of the 60% is invested in safer type of investments. So there's money market in there, there's bonds in there, so less risk of capital loss. Your 60 portfolios or your medium risk portfolios, so there, and your 50 portfolios, so they're just about half or over half of the portfolios are invested in growth assets. And of course, as I mentioned and I explained in the previous slide with growth assets, there is some risk that there will be capital loss, especially over the shorter term. And then of course your 70 portfolios, and these are the portfolios where members will be spending the majority of their working lives. These are the portfolios that, yes, they do take on the highest amount of risk. That's why on the risk spectrum, they're quite far right, but over the longer term, they're also providing you with the highest return. So back to that first slide of how to retire comfortably, you need to be invested in a growthy type of portfolio. So in these portfolios on the right-hand side, that take on a higher risk so that you can be rewarded with that return over the long term. So all of our 70 portfolios, as well as the single managers and the Islamic balance portfolios, these are all constructed in such a way to achieve that inflation-beating return over the long term. And how we do that, from a construction perspective, there's a lot of data out there, and our investment team and our asset allocation team, when they're looking at how do we actually construct these portfolios, they look at all these data points and they have forward-looking views on these asset classes. So they'll have a forward-looking views of where they believe equities will be over the long term, looking at various aspects such as, where we, with regards to growth, which are the stocks we are tracking. In the bond space as well, in the income space, in the global equity space. For each one of these asset classes, they will have forward-looking views to say, well, I believe that equities will give me inflation +5 over the next however many years, and I believe that bonds will give me X amount. Once we know those forward-looking views, and considering, of course, historic returns and where markets have been in the various market cycles, the investment teams come up with a nice mix of assets that with a high probability over the long term will get you those inflation beating returns. So I thought maybe it would be interesting for you to see, and I do show this at all the monthly presentations, but to put context into this portfolio construction process, this is really where your portfolios are invested. From a strategic asset allocation perspective. And what you'll note is that the portfolios on the very right-hand side, so your 70 portfolios, they have a higher allocation to growth assets, just like we've spoken about. You need these growth assets for the long term to get you those inflation beating returns. So there's more equities and less money market in those 70 portfolios, and the opposite is true for your 40 portfolios. There's a lot more money market, a lot more bonds, a lot more income generating assets, and less of the equities and the global equities. But when we do construct these portfolios, even though the theory tells us that over the longer term, you will be rewarded for taking on the risk. You are rewarded for buying into equities, into global equities. So you're rewarded for purchasing shares of companies over the longer term. We do experience negative returns. And there's never been a more appropriate time to discuss this than now. 2020, we've seen crazy market volatility. We've seen our worlds being turned upside down. We, all working from home. We find ourselves in the midst of a pandemic, and the worst months in the markets were February and March. What I've got here is just a long-term chart of the Johannesburg All-Share Index, so the JSE All-Share Index. So this is a representation of the larger stocks listed on the Johannesburg Stock Exchange. And you'll see that over the long term, if you invested in January 2010, your money definitely would have grown. But what you will note is that the line is not smooth. There's many dips in this long-term upward trajectory, and every dip essentially shows you what in your statement you would potentially see as a negative return. So over the long term, shares go up and down, but over the long term, the trajectory is definitely up. And the biggest dip you see is towards the end of this chart, and you see what happened in the markets this year. So you see quite a large drawdown, but then the markets have pretty much recovered as well. So why is this important? This is important is because we need to understand it. We need to accept that this will happen. Even without a pandemic, you'll see before this large dip, all the years before that, it's not as if this JSE was growing smoothly. There's always market volatility. Why that market volatility happens is because this chart is based on the value of a basket of shares, and those shares have a different value every minute that you look at them. So you're looking at NASPER share and BHP shares and all the banking shares, and today they're valued at one price, tomorrow they're valued at different price. And the reasons why the valuations of these shares change ever so often is the short-term volatility is really due to the dynamics of supply and demand. If there's a lot of demand for a certain share, so for example, we all switch on our TVs and we see that NASPERS, there's a piece on NASPERS that they're discussing on the business news, and if we had to, for example, see that they're really doing well and they're buying up all these companies and they're really set to grow, everybody will want to go and buy these NASPERS shares. The more people that buy these shares, it creates a lot of demand, and then the share price will move up. The opposite is also true. When Steiner failed, We saw that once Marcus Jooste had resigned a few years ago, everybody woke up to these news, and Steinhoff investors got very, very scared, and they started selling their shares, thinking, well, let me sell now because this company, is involved in all sorts of things, and the share price is probably going to go down, so let me sell out while I can. The more people that sell, the faster that share price goes down. And it doesn't always have to be extreme news events that makes these prices go up and down, but the reality is that at any point in time, there's a lot of people wanting to buy shares, a lot of people that wanting to sell shares for various reasons. There's pension and provident funds that are buying shares, selling shares in order to meet liquidity needs, and all this buying and selling creates this market volatility, in addition to some of the good news or bad news that we see in broad markets as a whole. So the important thing here is that negative returns are something that we accept, something that we model into our projections when we construct these portfolios, and we accept that by investing in equities, we will have market volatility. What's important is not to make short-term decisions when you are invested here for the long term. So the mistake we wouldn't want any member to make is when the market crashes, and if we look at this specific chart, if you had to panic on the way down to say, every day I switch on the news and markets are going down, or every day I'm logging into my online portal to see the value of my retirement fund, and every day it's actually worse than the day before. Let me rather switch out and put my money in cash where it's safe. What you're doing then is you actually crystallizing your losses. So you're selling out of the market when the markets are down, and you've already lost whatever you have lost on the way down. You crystallize your losses, and then typically nobody knows how to time the market. So typically members re-enter the market when it's too late. They wait for the good news, they wait for the market to tick up. Once it started ticking up, it goes back up just as quickly as it fell. Especially in this specific example of 2020, the market fell very quickly, but it recovered very quickly as well. And then you want to, with that same pot of money, you're now buying shares that are more expensive, and you've actually crystallized the loss. Whereas had you just stayed invested, what would have happened is, yes, the value of your portfolio would have gone down in February, in March 2020. But what we're doing in those times is we're also taking advantage of a lot of the opportunities. So if, for example, you are contributing 1,000 Rand every month into your retirement fund, with that same 1,000 Rand, when the market is down, we are actually able to purchase a lot more shares for you with that same 1,000 Rand, because all the shares are quite cheap when the market has crashed. And when it recovers, you now have more shares that are growing. And this is the reason why over the longer term, it's the most beneficial is to make an investment decision and stick to that investment decision over the longer term. The market moves that go up and down can be really quick, and that's why, just as an example, we've included some numbers. If you look at this little table on the right hand side, if you look at February 2020, very volatile month. The best day was on the 4th of February, where the market gave you 1.7% for the day, and the worst day was the 28th of February, and the market lost 4.5% that day. If you look at March, the best day, it's even more extreme. The best day was 7.5% daily return on the 24th of March, but less than 2 weeks prior to that, the market lost almost 10%. So these moves happen in a very unpredictable manner. We cannot sit here today and tell you that the market will move up tomorrow. We also cannot sit here today and tell you that the market will move down tomorrow. It's very unpredictable, and that's why it's important to have that long-term view in mind and to say to yourself, even though the market might be going down, my investment managers are actually using this as an opportunity to buy underpriced shares, and I will benefit from this over the long term. So we've done some work to show you that over the longer term, the probability or the chances that you have a negative return become smaller and smaller the longer your investment horizon. So what we did is, for all of the life stage portfolios, and I will run through these slides and I'll explain as I go along, but essentially for all of the life stage portfolios, the signature, the skeleton, and the synergy range, we did some analysis to show you the percentage of times that you would see a negative returns over various rolling periods. So if we look at this slide, for example, we're looking at the Signature 40 portfolio, remembering that the 40 portfolios are aimed for members that are closer to retirement. Now, if you have to look at the returns on this portfolio every single day, so on a daily basis, 43% of the time, you actually will see a negative return for the day. If you look at it over a week, so week 1, week 2, week 3, etc., over a week, there is also 36% of the time you will see a negative return. So more likely than not, even over a day, you will see a positive return because these are conservative portfolios, but about a third of the time, actually more than a third of the time, 36% of the time over a week, you will see a negative return. The longer the period, the less likely it is that you will see a negative return. So looking at it over a month, looking at it over a quarter, looking at this portfolio over a year. So the chances that you see a negative return of the Signature 40 portfolio over 1 year is less than 1%, and over a 3-year period and over a 5-year period, it's 0. So yes, as I showed you in the previous slide, a lot of market volatility, a lot of intraday movements on the markets, but over the longer term, it's 0. The probability that you see a negative return from the Signature 40 portfolio over a 5-year period is 0. And these are historic actual numbers that have been backtested. Now, with the more aggressive portfolios, you will see a higher likelihood that you see a negative return, especially over the shorter periods, but that also becomes less and less likely as you look at this over the longer term. So again, you know, over 1 day, much higher probability than what you have over a year, but even in the Signature 50 portfolio, over 3 and 5 years, there hasn't been negative returns over a rolling 3-year or a rolling 5-year period. The Signature 60 portfolio, so this is more aggressive, about 60% allocation to local and global equities, and you'll see that again over the 1 year that probability is very small. So the percentage of negative returns over a 1-year rolling period has been 3.2%, and over 3 and 5 years, again, it's 0. So that's really the part that I want to leave you with today is really, we're not investing for the next 6 months. We're not investing over the 1 year. We're not even investing for the next 3 or 5 years. We should be looking at 10-year plus, 20-year plus, depending on your age. If you're in your 20s, you're looking at a 40-year time horizon. But even if you're in your 50s and you're retiring at the age of 65, we're talking another 15 years of being invested in the market. And I'm showing you that over a rolling 3-year or over a rolling 5-year period, even if markets experience some extreme market events, it's unlikely that you see a negative return. And then the Signature 70 portfolio, as much as this portfolio is predominantly invested in growth assets, a lot of equities, a lot of global equities, you know, some asset managers out there invest in property. There's no property in these portfolios, but these are higher risk type of assets. So of course, on a day-to-day basis, it's very likely that you see a negative return. In fact, 44% of the time. But again, the longer that period, the smaller the percentage of negative returns. And focusing on that longer term again, markets do recover over the longer term. We've done the same analysis for the skeleton and the synergy range again. So I'll go through those slides relatively quickly because exactly the same thinking was used, and exactly the same method was used in order to produce this analysis. So if we look at the skeleton 40, more conservative, so less likely that it's negative over the 1 year. The percentage of negative returns here, 1.3%. The skeleton 50, 5.1% over 1 year, and the skeleton 60, a little bit more, and I'm just focusing on that 1 year number for now, and the skeleton 70, a little bit higher. But again, over 3 and 5 years, the percentage of negative returns over those rolling periods has been 0. And lastly, for the synergy range, now just as a reminder on the synergy range, this is where the local portion, so the 70% of these portfolios that we invest locally, the asset allocation decisions here are outsourced to the local asset managers. And the 30% global is exactly the same against all 3 ranges. These portfolios also don't have as long a track record to go back to do rolling 3 and 5 year returns, but again, very similar numbers that we're seeing over the 1 day, 1 week, 1 month, etc. So the bottom line of the story today really is that yes, we do expect and we fully accept that very regularly we will see negative returns. We will see that especially more often if you look at your portfolio on a daily basis. We will see it very often when we're looking at monthly performance. Members get annual benefit statements, even over 1 year. It is likely that you do see a negative return depending on the market environment and depending exactly when your benefit statement is issued. If, for example, I mean, we saw some of the worst days in the markets in March. If your benefit statement, if you received or logged on to your portal in March, it's very likely that the 1 year return on one of your 70 portfolios that you invested in, you know, was negative. But it's important to note that the longer the period, markets do recover. It's important to understand that volatility, to be able to stomach the volatility and to focus on the long term, to know that yes, you know, it looks like I've lost money comparing to how much I had last year, but I also know that my asset manager is buying up all the opportunities and I will be rewarded for taking on this risk over the longer term. So if I could leave you, before I get into the performance, which is the last thing I will cover today, you know, with some words of wisdom, is to not to panic. You would have heard this before, but don't panic. The worst thing you can do is panic, because as I mentioned a little bit earlier, what members do when they panic is that typically, instead of buying low and selling high, which is what investment theory tells us to do, if we know, you know, when the ups and downs of the markets are, ideally you should be buying when the market is cheap and selling when the market is at an all-time high. But when markets, you know, when markets are in turmoil and members are panicking and there's so many bad news out there, they tend to do the exact opposite. Markets are falling, that's when they sell out into cash. And when everything is great again, the markets are running and investors are keen to get into the market, that's when investors go back in. So essentially, they're selling low and buying high. And over the long term, these type of investment decisions with the effect of compounding can really hurt you over the long term. Focus on your investment timeline. If you're a young member, if you have more than 5, 6, 7 years to retirement, you should not be as concerned about short-term volatility as an older member that might retire in the next 2 to 3 years. Another thing that's comforting is that bear markets are shorter than the bull markets. So yes, we can, you know, experience a lot of pain. We saw it now in the first quarter of this year. We saw it in 2008 when there was a global financial crisis. So we've seen periods of market pain and how long it takes to recover. But if you look at the history of various stock markets around the world, those times of bear markets where markets are falling and really not rewarding investors are much shorter than the times where markets are good and they're running. And then lastly, again, just don't time the market. So again, don't panic and don't time the market. From an investment performance perspective, this chart, very similar to the all-share index chart that we looked at a little bit earlier on. These charts here, the graph shows us the growth of the various 70 portfolios against the global large manager watch median over the last number of years. And again, you can see that the growth has not been smooth. There's been points where the portfolios have struggled, points where they've done really, really well, but over the long term, they have grown. The global large manager watch median is a very well accepted benchmark in the retirement fund space, and it's made up of the median performance of the managers that are listed at the bottom of the slide. This performance is also prepared independently. So the global large manager watch median comes out of the Alexander Forbes surveys. So what these large managers do, and I've listed them at the bottom, so your Allen Greys, your Investix, your Coronations, what they do every month is they submit their performance to Alexander Forbes, and Alexander Forbes prepares these surveys. They calculate that median performance, and it's considered a very good benchmark. So if your portfolio can beat this median performance of all these large managers, you're considered to have done well. And you'll see that all of our portfolios over the long term have actually outperformed that median performance of that manager. You'll be familiar now with how to read these risk and return charts, as we spent a little bit of time discussing this at the beginning. But essentially, for any portfolio, for any level of risk, so if you're looking on the horizontal axis, for any level of risk that you will want to take, you want the top performing portfolio. So if we look at the portfolios that take on about 9% of risk, and risk here is measured by standard deviation. If you look on the horizontal axis at 9% and you look directly up, you want the highest performing portfolio. So over the 7-year period to 31 July 2020, it's actually the Sygnia 70 fund that has provided you the highest return for that level of risk. So for every level of risk, the top performing portfolio has been the best from a risk and return perspective. The reason why we look at this is you wouldn't want a manager to take on an excessive amount of risk but not give you the return that a member deserves for taking on that risk. So for example, some of the portfolios are a little bit further down, and I really don't want to pick on anybody, but looking at someone like a Sanlam MM60 or a Momentum Enhanced 5, they've taken on the same amount of risk as your AF Performer and our Sygnia 70 and Synergy 70 fund. They've taken on also about 9% of risk, but they simply haven't rewarded you with the return. The return has been much, much lower. So broadly speaking, all of these life stage portfolios on the risk and return spectrum, they've done really well against competitors in the space. And another important point to note here is that all of these portfolios are Regulation 28 portfolios. So we are comparing apples with apples. It's a meaningful comparison in the sense that these are all viable, investments for retirement funds. So this is what's out there in the market. Just a reminder of where these funds are invested, or rather which managers and which strategies we've chosen to implement on the strategic asset allocation decisions over the long term. You'll see for the signature range, this is the range that's a blend between active and passive management. And you'll see in the equity space, we do utilize the Sygnia Switch Tracker, which is a passive way of investing, but we also use some active managers. And likewise in the bond space, and then on the international side, it's predominantly passive, other than your international ESG portfolio, which is that investment in the Oxford Sciences Innovation Fund. The skeleton range is purely passive, other than, of course, that allocation to the ESG portfolio, the Oxford Sciences Innovation Fund. But on the local side, it's all indices. So this is the low-cost version of the signature range. And then the synergy range, this is where I mentioned it a little bit earlier on, but on the local side, the asset allocation decisions have been outsourced to the Allen Greys, Coronation, Investec, and Prudential. Investec has rebranded to 91, so wherever you see 91, just know that that's the old Investec Asset Management. So these are the managers that are being used in your portfolios, and of course the international portion is exactly the same across all three ranges. And from a return perspective, these returns are gross of fees, and they are as at 31 July 2020. And we have compared them to similar portfolios, and these numbers come directly again from the Alexander Forbes survey, so they've been prepared independently. We are comparing like for like over here. So for example, on this slide, we're looking at in the low equity space. So we're comparing our 40 portfolios, so our Skeleton, Signature and Synergy 40 portfolios against similar portfolios in the market. So all of these portfolios would have a relatively low allocation to equities. So you're not comparing a very conservative portfolio to a very aggressive portfolio. They're all bucketed in this low equity multi-managers. And you can see that the portfolios have top performance over 1 and 3 year period, and the Signature 40 fund is the second best performing over a 5 year period. Against 7 and 10 years, you can see that these portfolios have done the best against all peers. What you'll also note is that over 10 years, there's less competitors in the space because not everybody has a 10-year track record as yet. These returns are also annualized, meaning that if we look at the 10-year figure, the Signature 40 fund has given you 11.1% per year for the last 10 years. If we're looking at the low to medium equity space, so slightly more aggressive, again, all of these portfolios are very similar from a allocation to equity perspective. And the Skeleton 50 funds have done really well against peers across all periods, and they're top performing over the long term. And over the long term is really where it matters. That means consistency, that means consistent good returns over that last decade. The medium equity space, so the 60 portfolios, again, top performance against peers over 1, 3, and 5 years, and top performance against over 7 and 10 years. And then, of course, the portfolios that we always focus on, the portfolios where the majority of the members will spend the majority of their working lives, will be in these 70 portfolios. And what's very interesting to note if you look over the 1 year is just the dispersion of return between some of the best managers and the worst managers. So the best performing portfolio in the market in the Regulation 28 space has been the Signature 70 portfolio. It's given us an 8.5% return over the last year. That performance continues on at 3 and 5 years. Again, it's these portfolios that have been the best performing. It does change where the Skeleton is better over 3 years and the Synergy is the best over 5 years, but broadly speaking, top performance from all of those funds against competitors over all of these periods. And again, over 7 years, all three of the ranges have been top performing funds against peers, and over the 10 years, the Synergy range doesn't have a 10-year track record, but had you been invested in the Signature 70 or the Skeleton 70, you should be smiling because these have been the best performing funds out of all the competitors over 10 years. And the Signature 70 fund has given you 12.2% per year for the last 10 years. Always interesting to have a look at this performance relative to single managers as well. And we know with single managers, we can never expect to have one single manager that outperforms in every market environment. The reason that is typically single managers, in order to differentiate themselves, so to have something, you know, more unique about them. They typically tend to have very strong views with regards to their process and philosophies. So some follow certain trends, some are value investors, some are growth investors, some are quality investors. So they follow either a trend or a factor, and that's what differentiates them from the others in the space. And over the long term, we don't expect one manager to outperform all others in various market environments, because not every market environment will work for that factor or that style of investing. So Ford, for example, they take very strong views, and it has paid off over the 1 year. We can see that they've shot the lights out relative to everybody else, but looking at them over the 3 years, they have fallen further behind. And looking at them over 5 years, you can see that they're also behind many of their peers. And the signature, skeleton, and synergy portfolios, they have, even against the single managers, they have managed to be in that top quartile of performance. And in fact, over 5 years, the Synergy Fund has been the top performing. And then against all single managers, the Signature 70 Fund has been the top performing. So against multi-managers and single managers, these portfolios have been the best performing out there over 7 and 10 years, which is really great for members who have been invested here. So that's all I have in terms of slides today. We will make these available to you after this presentation. And I'm happy to take some questions. And if there are no questions, I haven't seen any at the moment, what we will do is you're welcome to email us your questions after the session, and we will respond to these questions in writing. So thank you very much for joining me this morning, and I look forward to presenting the August update to you in our September session. Thank you.